Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the August investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the markets and the investment universe that you need to know right now. Bob, we were just chatting before we turned the mics on, and there was actually a lot to talk about coming out of July.
Yeah. Hi, Sammy. Yeah, sometimes we do these and it's following a quiet month and we say, well, what are we going to talk about? But July was quite an interesting month, a lot going on in markets. Mainly, it started with the cool CPI report, where inflation that was released in July, but measured for the month of June, came in at negative 0.1%. Markets were expecting positive 0.1%, and the Fed's been, on this battle against inflation. And when the inflation reading is negative, that's deflation. So, where's inflation? And that led to some big moves in markets, which we can talk about. Moves in the bond market, moves in the stock market, moves across different investment styles, and also with that changes in expectations for Fed policy. And the Fed had a meeting yesterday where they talked about that. So we can dig into.
Yeah, so let's go through it. I mean, the first thing talked about was the July inflation number, which was the June report, coming in better than expected. And, I've talked about this and pointed out some of my content. Markets moved. We saw a rotation. We saw asset class performance change. You alluded to that. So what's behind the numbers?
Yeah, so I think the last two podcasts or so, we've talked about the valuations looking stretched in large cap growth, talking about NVIDIA and big tech, and they look a little expensive compared to history. And one of the questions is, if that cools off, what happens? And there's really two outcomes. One is it's like the 2000 tech bubble and everything sells off and it's a tough market. A more optimistic path is a rotation, and people trim those positions and buy what has lagged, buy the cheaper positions. And that's what we saw. We saw what the pundits are calling the rotation trade, where tech is selling off and value stocks and small cap stocks are rallying. And that report came out, the CPI report came out on July 11th. On July 11th, the Russell 2000 small cap index rose by 3.6%, and the NASDAQ, which is typically mainly large tech, fell by 2%. So in one day, you saw over 5% spread, which was the largest single day outperformance for small cap in over 40 years. So when you see, typically we're not looking at day-to-day movements and reading into it too much, but when you see something like that, that's a 5% spread and it's the biggest in 40 years, so, you look into it and say, okay, what's going on? And that trend has continued. Looking at numbers in the month of July, MSCI USA large cap growth was down negative 2.22%. And then looking at kind of the opposite of large cap growth in the US is small cap value. So not large, but small, not growth, but value. MSCI USA small cap value was up 9.89% over the last month. So about a 12% spread over the last month. And when we look into that, what's going on? Why is this happening? Well, the market has been adjusting to a path of the Fed cutting rates, and it's now priced in actually over 100% chance. It's more a question of, is it a 25 basis point cut or a 50 basis point cut based on market pricing, as opposed to 0 or 25 at the September meeting. So the market is pricing in Fed rate cuts for the remainder of this year. 3 at this point is the base case, 3 cuts. And when you look at small companies, what does that have to do with small versus large and tech versus non-tech? One of the things is with financing. Large companies like S&P 500 companies, if you exclude banks, because banks have a lot of short-term financing, most large companies have fixed rate financing. So their debt is fixed term. Think like a mortgage. It's like a 15-year, 30-year mortgage. It's a fixed rate mortgage. And when you have fixed financing, the bank is taking interest rate risk, or lenders are taking interest rate risk. And that's what put Silicon Valley Bank out of business. they had a lot of fixed rate debt at low rates. Then interest rates go up, depositors want to get paid more, and they're in trouble. The net interest margin goes negative and the bank goes under. Smaller companies where there's more credit risk, the bank and lenders have more negotiating power, you could say, on the debt side. So they tend to issue more floating rate debt. And if you look, it's about half of small companies, half of their debt is floating rate. So as you see a decline in rates, that's a decline in their debt servicing cost. So when you're kind of looking under the hood, why are small caps rallying on this news? That's one of the reasons you could get to explain it. Another is just simply that large growth has gone up too far too fast, and it's an excuse for it to cool off. So that's some of what we saw in July.
So, Bob, how do you price in greater than 100% chance of a rate cut? You mentioned that a while ago, and I didn't want to stop you, but I was curious, how can that be possible?
It's so the market as of the end of July is pricing in a like a 28 or 29 basis point rate cut.
Oh, I see. Okay, so
So
more than 25 basis points.
it's
Yeah.
waiting. So you could say if there's a whatever a 95% chance of a 25 basis point cut and a 10% chance of a 50 basis point cut. So
Understood.
that's how you
Yeah.
get it.
So, Bob, that July inflation number, which again is the June number, is that enough of a catalyst to drive such a massive rotation? Or are you thinking which you also said that it could be a combination of that and just stretch valuations and people needing a reason to make the rotation?
It is more than just that report. So that came on the heels of a previously good inflation report released in June for the month of May. And meanwhile, so inflation has been cooling. So just in general, it's the direction. So the inflation data has been favorable. And then meanwhile, the Fed has a dual mandate. So on the labor front, the jobs market has continued to cool. So job openings are down to about 8 million. They peaked at 12 million. So it's about 4 million job openings that have gone away. Unemployment has been ticking up. At the Fed's press conference yesterday, Powell said the downside risks to the employment mandate are real now. So that's a very direct line. They've been talking about how, okay, it's labor market's looking a little softer. It's more on our radar, but it's definitely now more of a balance where there are real risks that they're seeing to employment. And meanwhile, inflation is looking less and less concerning. So they changed in their official statement, that their focus is to both sides of the dual mandate. It's much more of a balanced picture. So it's not just one inflation print. We've had multiple that have been cooler. And then meanwhile, the employment picture has been softening.
So just looking back at some of the numbers, I see that small caps have really been outperformed by large cap by a wide margin for the last 3.5 years. So some of that was during a higher rate environment, but some of it wasn't. So some of it was in a low interest rate environment. So it feels odd to me that the possibility of a 28 basis point rate cut would be enough of a catalyst. To your point, I do feel like there must be a lot more to the story.
It's an interesting observation, and the investment team has talked about this because you just have to go back to 2020 when rates were falling, when COVID started. The Fed was cutting rates and rates were falling, and growth stocks were doing well. And the story at that time that the pundits were saying was tech does well, growth does well with low interest rates because you value a growth stock using like a dividend discount model. And if your future cash flows are decades out with a lower discount rate, the way the math works, the present value of the company is higher. So it's low rates are good for tech, high rates are good for value. And we saw that play out for a couple of years. So that in 2020, when rates were going down, tech was doing well, but then 21 and 22, when rates were going up, value did well. So the market kind of bought the line that low rates equals good for growth, high rates equals good for value. And now it kind of switched where it's, wait, now you're telling me low rates are good for small value or small companies and bad for tech. Which is it? And when you look at market action, it definitely does seem correlated on a day-to-day basis. So
What seems correlated, Bob?
Interest rates and call it like a small to large premium or value to growth premium. So that
Okay.
when rates are going down, that tends to be better for value and small. When rates are going up, it's looked more better for growth, which is the opposite of what we saw just a couple of years ago. So the question we've been asking is, has the market just kind of bought this line and it's acting on it, but it just kind of regimes change? Just going back a couple of years, back in 2020, we asked like managers and did research and like, is this a temporary phenomenon or is it in the data? And what we heard is if you look over the last 80 years, there is no relationship. So while it might make sense now, it's not in the data, and we're seeing a reverse of it. So I think it might be more within this current market environment. It does matter, and it could be short lived as far as like a year or two. It's not like indefinitely that this relationship will exist.
And sometimes you just need a catalyst for a rotation to happen, right? And definitely there has been a lot going on, punctuated by what you talked about early in July with the June report. So, what does that mean for portfolios, Bob? I mean, when you guys were kicking it around as an investment team, I guess it has real world implications for how you're going to allocate the US stock portion of your portfolio. And is it, whether you would be talking to investors about this rotation being real and it's just starting and it is time to increase your small cap and your value exposure if you've been underweight this long?
Yes, is the short answer, that these things do tend to go on runs that are longer than a month. When you see a big move like this, you should pay attention to it. And the large growth compared to small value trade uh, has looked stretched. So it needed a catalyst. It has the catalysts. It's moving, and it still has a ways that it could run.
And Bob, another thing that's going on is that yields are dropping, right? So the 10-year, I think today is below four.
Yes, 398 right now.
390. All right, so just below four. Why, I guess, and what does that mean? First for bond investors, and then just ultimately, what do you see or what do you take away from, yields backing down?
Yeah, so for bond investors, it's good as long as you have your bond positioning where you want it to be, like we talked about with the escalator elevator podcast. The Bloomberg US Aggregate Index returned 2.34% total return last month.
Hmm.
So 2.3% in a month in investment grade bonds, pretty healthy return. So bond investors should be seeing appreciation over this period as interest rates have declined and giving you a nice total return. And the longer your maturities in general, the better you've been doing with more interest rate risk as rates have declined. And that's just the market's way of pricing in a good amount of Fed rate cuts over not just the remainder of this year, but going into next year. So it's the market's way of saying we're not that concerned about inflation. We're more concerned about economic growth, and we're expecting interest rates to decline. That you see that in the price of the 10-year. So it's still a decent yield at 4%, but it was 4.7% just about 4 months ago.
Oh wow, that's a big move.
Yeah.
And I've seen that has filtered into mortgage rates, which are now, I believe, in the high sixes. So we're starting to see some, even though the spread is still high, we're starting to see some easing of mortgage rates and hopefully getting to more of an equilibrium, in the fives and instead of staying at the high sixes and sevens.
Yeah, mortgage rates are improving, still not where we saw them, 3, 4 years ago, but directionally it's getting a little better.
What's going on in the international markets, Bob? I know that, I've followed what you laid out, and I've been particularly interested in, the rotation and what's going on in the US equity markets. I've seen big winning and losing days for the international markets relative to the US in that month of July. Is there anything kind of notable in your mind in terms of what's going on overseas?
Not too much. The MSCI EFA index returned 2.93% for the month of July, so healthy, about 3% return. Emerging markets, about flat, up 30 basis points. China did cut interest rates, so they are looking for stimulus. There's, some economic trouble there. The market is cheap on a valuation basis, but they're It's in a different stage in their cycle than the US, and that's reflected in prices. So, but overall, on the whole, those markets were up, have done well. Not keeping pace with the US year to date, but still year to date, developed international measured by the EFA is up 8.4%. So
Yep.
healthy return.
Sure.
Novo Nordisk is their star child for the winning stock with the weight loss drug. I think we've talked about that a little bit. So that's kind of their Nvidia equivalent. But those markets are doing well, and I don't think we're going to dive into politics on this episode, but sometimes
Or any episode for that
or any
matter, Bob.
episode, but gently touch on that. Sometimes clients bring up political concerns, and one of the natural answers is diversify globally.
Yeah.
Uh,
Well, if that's the extent of you bringing up politics, I think we can handle that. There it can go in a lot different directions. So, Bob, investors get fired up about rate cuts. They think they're going to, boost their portfolios. I think from a personal finance point of view, if you have variable rate, your interest rate goes down. It's good, can be good for consumers, but a rate cut is not always good news. Is it? Are we seeing that the economy is slowing down, which is also part and parcel of why the market is expecting a September cut that is now priced in at more than 25 basis points?
There are some concerning signs, not a lot. Like the leading economic indicators ticked positive for a month a few months ago, but they remain in negative territory. And when you think about things like the job market, with fewer and fewer job openings, that tends to be a leading indicator. Like if
Sure.
employers are taking down the help wanted sign, well, why aren't you hiring? Well, I'm concerned about the future. So it's things like that are with leading indicators. You do have to dig a layer or two, and admittedly, it can be a bit of a stretch to kind of interpret that. But there are call it like a yellow light. Just tread carefully, and that's what the Fed sees. That's why they're cutting rates. They're not cutting rates because everything's great. They're cutting rates because risks are increasing, and they are becoming increasingly concerned about a recession. So recession risks, I would say, are ticking up and up. And to avoid that, their mechanism is to cut rates. So it's not, crisis is around the corner, time to cut rates, but it's, there's elevated risks and they don't want to tank the economy. So they're going to be cutting. So you're right to, I think, frame it that way, that there's a little bit of be careful what you ask for and be careful what you're celebrating. They're talking about cutting rates, or they likely will be cutting rates in September because they are concerned about the labor markets. So they are concerned about economic growth, and that's their way to address that concern. So that's one of the things we're looking at, and that does get to supporting a healthy allocation in fixed income for clients where it's appropriate.
Mm-hmm.
Because if you do have that risk event playing out, fixed income should do well. You'd see more rate cuts, and that's one of the reasons why we're diversified for clients who need that level of risk management in their portfolios.
And if I had to guess, and the good news is my guesses don't matter to individual investor portfolios. If I had to guess, with how telegraphed this rate cut has been and how priced in it is, which you led off with, I would imagine that the market doesn't really react with exuberance when we finally get that cut.
To your point, yesterday was interesting because they basically did reiterate that, and the market didn't move much at all. It
Right.
was a real non-event of a day. So if it does seem to be priced in, but the market can be real jumpy around Fed meetings, and it critiques Fed statements with changing single words. It's a real delicate balance with the complexity of the pricing mechanisms to not have really any changes in price. That they're really walking a fine line to do that and have no change in expectations whatsoever.
So the takeaway outside of what you said is that you don't want to guess, and I don't ever want to talk politics. So maybe when we retire, we can have a podcast that's all about guessing and talking politics,
Sure.
and not get ourselves in trouble during our day jobs. So one thing we wanted to wrap up with is we had a listener question. I've actually received this question in a few different formats over the last few weeks. And as a reminder, if you have any questions, please submit them to wealthybehavior@heritagefinancial.net. We'd love to answer them for you. And Bob, the gist of the question is basically, as I'm getting older, as I am retired, living off of my portfolio, and the years are passing by, should I adjust my asset allocation and automatically make it more conservative? And, there's some background to this question, right? There's the whole, your age and bonds, type of approach, which has been adjusted over time. I have some thoughts on it, but obviously, with the way that we manage money, which is we start with your financial plan and an understanding of your ability to take risk, your willingness to take risk, and when you're going to need your portfolio to generate not income for you, but to support your lifestyle. It's probably the biggest starting point in terms of building a portfolio. And so I think you'd be a great person to answer. How do you feel about updating your allocation to automatically become more conservative as you get older?
Yeah, it's a great question, and that's what target date funds do. They assume that you should get more conservative as you get older, but my answer is it depends on your situation, and that's not necessarily the right direction. Your situation and your goals, and one of the main goals is what I would call the terminal value goal. We're all going to die someday. When you die, where's your money going, and what's your goal around that? So we have some clients who I know their call it terminal value goal is, I know one guy who jokingly said, I want the check to the funeral home to bounce, meaning truly die with zero. Like, I want to enjoy my money. I earned it. And I don't want my kids getting, a big inheritance. That's his goal. In that case, if then you crunch the numbers, and if a lower risk portfolio, more in fixed income, works to just kind of ride it out and end with zero, and not have to stomach stock market volatility, then more bonds probably works. Then I've talked to people who say, I view this as multi-generational wealth and I want to take care of my kids and grandkids. Then hold on a second. You might be 70, but your grandkids are 10 years old. So now all of a sudden, this money doesn't have 10, 20, 25 years to go. This money is 50 plus year money. So actually the conversation could flip to, it's not about getting more conservative, it's about getting more aggressive. The difference between those two profiles, both the client that we're working with could be, say, 60 or 70 years old, but that terminal value goal, ranging from die with zero to, take care of my grandkids, it leads to a completely different portfolio as
Sure.
far as what are you planning for, what are you trying to accomplish.
Let's assume for a second, Bob, most people are somewhere in between. I'd like to leave something behind. I don't want to bounce the check at the funeral home. If it reaches all the way to my grandkids, great, but I'd love to leave something for my family behind, and I'm not targeting zero.
Yeah, so then there's the in between. Then it really just gets to scenario analysis, and we have great software, great technology, and you can see what you'd call the ability to take risk. And really, the healthier your plan is, the more risk it allows you to take. So if you have a very strong plan, so call it a low withdrawal rate, like if you're withdrawing 2% a year, you can take a good amount of risk because of the 20, 30% stock market decline. It's still not going to put your withdrawal rate so far out of bounds that your plan becomes in trouble. Whereas if you have a higher withdrawal rate, there's less room for error, less room for heightened risk. If you kind of cut off the extremes that I used, you get more into a base case, and it's just more of an exercise of doing scenario analysis and seeing what works best. Typically, you still need a good, healthy return to make it work. So reducing risk maybe a little bit on the margin, but I typically wouldn't do it too much because you need to keep up with inflation and allow for a healthy withdrawal rate. But it does get tough to be very prescriptive when we're talking
Sure. But directionally, what you're saying is age isn't the predominant factor. It is the withdrawal rate from your portfolio, how long you want it to last, what rate of return you need, or what rate of return you want to target in your portfolio. And, it's not because 70 is different than 75 or 65 in terms of an investment strategy.
No, that's all correct. And it's just the other factors are the terminal value goal that we talked about. And then the one other consideration is the willingness to take risks. So there's the ability, that's just crunching the numbers. There's the willingness. And it is a mix. Some people might be older and say, I'm sick of the stock market volatility and seeing my portfolio move. I can't take it anymore. I don't want the stress. And others are, hey, I've been investing for 50 years. I know what this ride's like. I know when it goes down, it comes up, and I've got no problem taking risks. So there's kind of a mental, emotional aspect of it too, that especially if your plan allows for it, if it has some wiggle room, it's a fair consideration as practitioners to understand how people feel about that. Like I know talking to a client who's a retired financial service executive, and he just said, I'm done with the stock market volatility at this level. I just need a more steady return going forward. And even though the plan could allow for more risk, client's not interested. So we adjust.
I want to take you back to something you said earlier, which is if you need a higher withdrawal rate from your portfolio, you should be more conservatively invested, all things being equal. And sometimes we have people who come into us with the opposite mindset and they say, I'm going to need 5 or 6 or 7% from my portfolio. So I want to target, all stock so that I can earn 9, 10, 11% and give this thing a chance to meet my withdrawal rate. And, obviously we counsel them strongly to go in another direction. Can you just touch on that kind of sometime? I wouldn't say it's a misunderstanding, but it's a misalignment of what you said with what some people think in terms of what they should be doing if they have a higher withdrawal rate.
That's a tricky one. So if you have a high withdrawal rate, there are two paths. One, you can go for a higher return, and it can work if you actually get that return. But if you enter a poor environment for investments, for risk assets, for stocks, it can be fairly disastrous. And maybe you need your money in the last 20 years, and you step on the risk pedal with 2 feet, and it turns out to be 2007 right before a crash, or 1999 or early 2000 right before a crash, and your money doesn't last you 20 years, it'll last you 5 years, something really bad.
Because you're locking in a portion of the portfolio losses to take out that higher withdrawal rate for 2, 3, 4 years.
Right. Markets go down and you're withdrawing, so you're selling low, which we all know.
You're not riding it out like somebody who's not in retirement could do.
Goes down, you pull it out, you're locking in those losses. It's not coming back. So, but on the flip side, if you have a good environment, the risk on can work, and it does work more often than not. It's just the range of outcomes is wide.
Yep.
Whereas if you take a more conservative route, you could kind of narrow in on, we can make this money last between 10 and 12 years, for example. And I am, making these numbers up, but just kind of for illustrative purposes, a more narrow outcome that's longer, where the worst case scenario isn't as bad as just taking more risk. The worst case scenario that may not be acceptable, but with a high withdrawal rate, my advice would be it is a personal decision. And it's our job to educate clients on what the range of outcomes look like and what the middle ground path looks like. And so, for example, do you want, on average, this money to last, say, 13, 14 years, but it could only last 5 or 6 if we have a bad stretch? Or do you want it to last not 13, 14, but 10, 11, 12, and as bad as it's going to get might be 9 or 10, for example? And some people might, say, I'm willing to take the risk that it runs out in 5 if the base case is better. And that's taking risk. So we have the ability to educate and run those scenarios and have that conversation. And that's how I'd handle it on a case-by-case basis.
Great. No, thanks, Bob, for that recap. And again, if you have any questions, please send them to wealthybehavior@heritagefinancial.net, and we'll dive into them. So, Bob, I'm not going to see you for about a month. You're going on your sabbatical.
That's right.
You're not going to be working, which is the point of a sabbatical. But what's your most efficient, quickest way personally when you're not working to check in on the markets and just see what's going on, so you kind of stay somewhat connected to things when you get back?
Few ways. I do watch a lot of CNBC, have it on in the background just to kind of get a pulse of what's going on. I do think a lot of the people they have in there are good and plugged in. I have a Twitter account. I don't tweet, so don't bother following me. But I do follow basically only financial people that I like and respect. And you go on there, and since I really have no other nonsense coming through pretty quickly, you get a sense of, people sharing interesting articles. So I do find that to be a pretty good platform. And I do get a ton of newsletters. Schwab's market commentaries are also pretty good.
Yeah.
So those come out typically every 2 weeks.
Mm-hmm.
So be a little patient there, but they do a nice job summarizing things. So Wall Street Journal,
Yep.
of course, is I think a pretty good publication covering the news. So no shortage of staying up to speed on things.
Great, Bob. We'll keep things together for you for the month while you're gone. I look forward to talking to you 2 podcast episodes from now. And thanks for sharing your insight today.
Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.